Greetings, test takers. Welcome to our second explication of a practice test for Series 66. If you're on the 66, you're probably on the third leg of your testing journey, the final leg for most of you. Don't forget those on the first leg, SIE, and the second leg, Series 7, to tell them about the resources of my channel here. A couple of housekeeping details. One of the favorite things that people like is explications of practice exams, our viewers and our subscribers. And so we're always trying to provide those. This channel is a free supplement to your paid study materials. And as a result of that, people sometimes say, hey, Dean, I got a 90 on your practice exam. Can you send me the PDF? Can you send me an answer key? And if that were the case, I'd be sending you to a website where you could download the PDF and, buy stuff. That's not what the channel's about. Who knows, maybe someday. But knowing that people have that want, we have a collaboration with TestGeek Exam Prep LLC and its managing member, Brian Lee. And as part of that collaboration, we're able to explicate the TestGeek finals, like the one we're about to do for 66. And you can go download that PDF and the answer key rationale. That's $24.95. I will link the website and his YouTube channel if you'd like to do that. With the 20% off, that ends up being $20 for the PDF and the answer key of the rationale we're going to actually explicate. For 30, what is it? I think it's $39.95 or $49.95. I think it's $40 with the 20% discount. But let me get you a shared screen here. You can also, for that, upgrade and get the PDF and Brian's quick notes. As you see here, I've chosen a page to show you of the quick notes. I think this is Brian's version, TestGeek Exam Prep LLC's version of the STC Crunch Time Facts. It's a kind of a version, Brian's version of what Kaplan calls his quick sheets. I think it's a lot more in depth. It's got a lot more stuff for you. And for that upgrade, you can get, I think it's, don't quote me on this, $49.95, 20% discount, $40. By far the best deal is to buy the entire paid supplement that Brian has available for each of the series. And that's $100 with the 20% discount, $99.95, call it $100, $80. And you get all the supplement, including all of Brian's videos. Again, you can check out his videos. I'll link to one of his sample videos on 66 or, something so you can sample that. There's also a link on my channel to Brian's website, as well as a link to his YouTube channel. Okay, so now that we got that housekeeping out of the way, let's get going with our explication of the final exam. This will be the second one we have available for you. The other difference in Brian's finals, TestGeek Exam Prep LLC's finals, is that they are diagnostic. There is a correlation. Brian has designed these to have a correlation with your actual exam. Mine are not. So practice test one is not a correlation. It's a way for me to share debrief and give you opportunities to practice, drill, and rehearse. So I get a little nervous when somebody says, "Oh, I got an 80 on your practice final." Well, that's great, but it's it's not an indicator. We're not trying to make practice exams that are indicators. Brian's is. So there is a correlation. So you might want to pause, try and answer the question. Once you've attempted your answer, then you can go ahead and see how you did. I'm going to turn my egg timer over for 30 minutes. Remember, you can always stop on these exams, take a break, and come back to it. So let's get started. I'll kill my video, and then when we're ready to take a 30-minute break, I'll pop back up. Okay, which of these portfolio allocations below would you expect to show the least volatility over the next year? So I like what Brian's done here. I like the test. He's giving you a lot of stuff that has nothing to do with answering this question. What you're getting tested on in this question is standard deviation. And standard deviation is a measurement of volatility. And so we're just going to simply look at the answer set and find the one that has the lowest standard deviation, which in this case, is choice C. Let me get my highlighter out here. For some reason, it's not letting me draw on this thing. There we go. Choice C. All right, number two. If the S&P goes up 5%, what is the most likely result for XYZ with a beta of 1.5? Beta is definitely going to be on the exam. So one thing you're looking for, whether it's My Practice Test 1 or TestGeek Practice Test 2, is what I call confirmation of the test issue. When you see something consistently in your Kaplan materials, your SDC materials, past perfect here, it's going to be there. Now, don't freak out. It's not as complicated, perhaps, as some of the test prep providers make it. So it means it's 1.5 times more volatile in the market. So we're simply going to take our calculator, get my calculator, and we're going to take the 5% times 1.5, and we get our answer of 7.5. Now, what would we call the excess of that? We got more than that. We would expect that would be called alpha. Alpha would be the excess return over beta. I'm oversimplifying, but that's pretty much what my job is. The method of computing long-term returns that takes into consideration the time value of money. Well, you can kind of do what I call process of elimination. So by process of elimination, you can say, well, no, that's not risk-adjusted return. It's not the real rate of return, because that would be, some kind of something about inflation in the question. It's not the after-tax return, because that would be something about taxes. And so by process of elimination, we would get the internal rate of return. The internal rate of return. So A, for example, in a bond that you buy today, present value, future value, that yield to maturity represents the internal rate of return. 4, an investor is looking at the past performance of a security over the past 3 years. It's returned 8% in year one, 15% year 2, year 3 returned 10%. This computes to an average of 11%. This would probably be referred to as, and you would say, arithmetic mean. Now, I like this question. Brian's done a really good job here, because a lot of times people say, how much math is on the 66? It's very much like question number 4 here. It's not so much, are we going to ask you to do the math? It's, do you recognize the math? And so I kind of like what Brian's actually done in this question. I'd be aware of the median return. That would be the middle number. I'd be aware of the range. I mean, you'll get something like this. I think Brian's done a really good job here. Now, I'm not really a big fan of number 5 here, but I do like the intellectual takeaway as an exam point. Which of the following pairs offers the most diversification? Under modern portfolio theory, what we're trying to do is provide diversification through what we call negative correlation, things that go different directions. And so, B, muni bonds and long-term U.S. Treasury bonds are going to go the same direction. Long cap stocks and blue chip stocks go in the same direction. And corporate debentures and convertible bonds, you could overthink this, but they go the same direction. And what really is the test question on 66 is to recognize that foreign securities add negative correlation to a portfolio. And so that is very much a test issue. I would also know that the easiest way for somebody to own individual foreign equity securities is through an American depository receipt. And so I like that question. Not so much the question itself that Brian has written here, but more the intellectual takeaway. According to efficient market hypothesis. Now you're going to get an efficient market hypothesis question. And here it says information based on company financials and factors is considered to be semi-strong. I think it's more likely what you're going to get is the strong version where nothing works. But anyways, the answer to this one is B. I suggest you make some flashcards for weak, semi-strong, strong. If you go to the playlist for 65, I do have in there some examples of this. And I also have some practice questions and another practice question set. By the way, if you're going to take Brian up on his PDF offer and buy this for $20 with the answer key, on questions like number 7, the answer is A by definition. What I might recommend you do is take your exam and print it out and then make what I call poor man's flashcards. Just, in questions like this that are aim and shoot, point and click recognition questions on the 66, maybe just highlight, A is the right answer And then the night before the exam or the morning of or both, just go through and read the questions and the right answers in Brian's exam here. Another reason that the PDF can be helpful. Which two are most associated with a Treasury bond? Well, again, by process of elimination, you should definitely know that U.S. Treasury securities do not have credit risk. You should definitely know they do not have credit risk. And the Treasury market, Treasury bills, Treasury notes, Treasury bonds, is the most liquid market around. I mean, trillions and trillions of dollars of this every day are traded. And so you can get in and out of Treasuries very, very quickly. Reinvestment, definitely. You know, in the early 80s, mid 80s, you know, you could buy a 20-year Treasury bond paying 15%. Oh my God. You know, your 20-year Treasury comes due. You said, Dean, just give me another 15%er. I said, well, those don't exist anymore. So you definitely have reinvestment risk. You're not going to be able to put the capital back out at the same rate of return. And if interest rates go up, the bond prices are going down. And that's true of Treasury. So you still have interest rate. You don't have credit risk, but you do have interest rate risk. You know, by the way, you could be immune from that by holding the maturity. But you said, Dean, I thought you told me I can't lose money in Treasuries. And I'm looking at my portfolio. My Treasury notes and Treasury bonds have gone down in value. I said, well, yeah, but that's only in the secondary market. If you don't participate, you just hold them to maturity, you'd be immune from that. You know, I was tutoring somebody and they said they were good at things. And what I liked is that sometimes when people tell me they're good at something, whether they really are is a different thing. And she, Dean, I got this teeter-totter seesaw down, and there's our flat line for the teeter-totter seesaw. Hopefully it hasn't been too long ago since you did your Series 7. And so remember, the fulcrum of the teeter-totter is what we call the nominal yield, the coupon, the fixed or stated rate of return. And so that's the fulcrum on that teeter-totter. And here it says current interest rates are 9. And so what that means is that interest rates have gone up. And when interest rates go up, that causes the bond to go down. And so this bond, you're going to get at least one or two of these on your 66. And again, I'm hoping test takers that, you know, you didn't just do your data dump on your Series 7 and do that. And so this bond is going to be selling at a discount. That's one reason I think you should take your 66 as soon as you possibly can, you know, after you get this done. Usually the one that's more Tesla is a bond selling at a premium. A company has two outstanding bond issues, both with a coupon of 8. Bond A will mature in 2 years, while bond B will mature in 15 years. So a good way to remember this is longer term bonds always have greater volatility and the lowest coupon. You know, the higher the coupon, the more stabilization will add on the price. Investments with income streams are more stable in price than investments without income streams. And the higher the income stream on the investment, in this case, the coupon, the more stable in price it will be. Now, that's kind of a tie goes to the runner here because they both have 8% coupons. So, you know, long and low. We're going to go with the longest term maturity, and we're going to go with the lowest coupon. Now, here it says, if interest rates were increased 10%, by the way, it doesn't matter whether that's 8%, 10%, 12%, it doesn't matter. Bond B is going to have more volatility, and that means it's going to go down further in price. I like that. That one's kind of I think Brian did a good job on that. That's a judgment question. You know, the 3 styles of questions you get are recognition, you know, aim and shoot point and click stuff, practical application, can you crunch current yield, and then judgment questions. And number 10, I think, is a very good judgment question. An investor is long 100 shares of XYZ. She fears a near-term correction, but overall she remains bullish. Which of the following will allow her to profit? Profit, that's the key word. You know, if this said allows her to protect, If it said allows her to protect, it would be buy a put. For protection, you buy the option contract. For profit or income, you sell this. I said, well, why don't we sell a covered call? And, we hope that money expires and that'll give you an additional profit. Sometimes the way we say that as a suitability question is covered calls are great for somebody who wants to generate additional income. In fact, this investor, she would have three sources of profit. I say one source of profit you have is from the stock going up. Another source of profit you have is if it has a dividend, that's yours to keep. And then we're going to create a third source of profit from selling this call. And so the answer is C. Now, I would tell you on 66s, the most important thing is this answer set. You should be able to look at that answer set. And once you hear profit or income, know it's either C or D, and protection, know it's either A or B. That's what you need to be able to do. Hopefully, your options prowess is still there from your Series 7. You're going to get a lot less options on Series 66 than you got on 7, certainly. An investor who's short 100 shares. So if I'm short 100 shares, I'm worried about the stock going up. Without any kind of a hedge means offset investment risk, I would have unlimited loss potential. And once we hear protect, we know we're going to have to buy an option. So I already am short the stock. So what I'd be interested in being able to do is to put in a ceiling and be able to buy back the stock at a set price at any time between now and some future date. And boy, that would make you a very, very smart bear, because now you no longer have unlimited loss potential. So the key point here is protect. When you hear protect, you're buying the option. When you hear income, you're selling the option. Life insurance. Life insurance can never be sold as a investment. That's one test question. And capital needs analysis may be helpful in all the following except. So they're asking you in which case is not going to be here. So I say, well, listen, we need to do a capital needs analysis, Jim, to see, if you die, what's going to be missing in terms of income for your wife and your kids. So A, certainly. I say, Jim, when you die, I'm just talking about Jim because Jim is a friend of mine, and I was telling him, when Dean, I don't sell life insurance, I'm retired, but I was never a life insurance guys anyway, but I was telling my friend Jim, if Dean is talking about insurance, Jim, you need insurance because I'm not an insurance guy. I said, but Jim, when you die, there's also going to be some taxes due. And so we're going to need some money for that. I'm not doing this to sell you more life insurance, right? You're not going to need to buy more life insurance because you're dead. I'm joking, and then you're not going to be here to be able to complete your investment objective. And so I kind of like this accept format. Now, again, if you're going to buy the PDF from Brian, which I highly recommend, and you want to turn this into a poor man's flashcard, I get rid of this accept, and I would get rid of this, and then I would have a good poor man's flashcard. And as I said, what I would do is read the questions and the right answers night of, morning of your test, or night before, morning of your test, or perhaps both. So I kind of like that one. Which of these describes a market maker? A broker-dealer who stands ready to buy or sell at least the standard unit of a specific stock traded over the counter. Yeah, that sounds pretty good. Now, I would like to read the rest of my answers. Make sure, we always say RTFQ, read the full question. But I also would amend that to say, read the full answer set. I just want to make sure that, there's not a better answer for me. A broker-dealer who stands ready to buy or sell at least the standard unit of a specific stock traded on a listed exchange. No, in a listed exchange, it's an auction order-driven market, and we're matching buyers with sellers. And so A still looks like my best answer. An investment banker who participates in firm underwritings. No, market makers are only in the secondary market. A subscriber to the NASDAQ system. No, there's different levels of subscription. There's level 1, level 2, level 3. And level 1 and level 2 subscribers are not market makers. So given that answer set, looks like A is going to be our best answer. Now, again, I hope that, your 66s, you just had your 7 recently. So hopefully some of that stuff should still be familiar. You're not going to get, as I mentioned, anywhere near the level of derivative questions you've got on your original Series 7. By the way, I just noticing that the exam I'm going through says 2019. This is 2022, but it hasn't been this content is current. So I just want to let you know the content is current. I could have just as easy put up the version of this that says 2022. So NASA is notorious for not updating exams. So if I bump into a question that is different from the 2022 version in Brian's practice final versus this version, I will certainly let you know. Which of the following are true? American options may be exercised anytime. That's true. European options may only at expiration. So if I'm the short the option contract, one of the risks I have in American style is anytime somebody can exercise me and make me deliver the stock or the money. American options are typical of equity options. In European options, if I'm short, I don't have that risk. I only have the risk at expiration that I'll be exercised. That's typical of non-equity options. Among the various forms a business may take, there are sole proprietorships and LLCs. Sole proprietorships and LLCs. The things they have in common is limited liability. No. Sole proprietorships have unlimited liability. That's why it's kind of foolish to be running a business as a sole proprietorship. Flow through of income and losses, yes. Ease of formation, yeah, they're both easy to form. Unlimited numbers of owners. Oh yeah, no, because sole proprietors remember only have one owner. The business and the owner are one of the same. Now, this is testable not only on this level, but it's also testable. Remember, in Form ADV, we have to tell what kind of form of business we have. Is it an LLC? Is it a C Corp? Is it a partnership? Is it a subchapter S? So this is testable on two levels, both as potential clients of an investment advisory rep, as well as how we organize our investment advisory firm. A grandparent wants to provide $1,000 per month in perpetuity per grandchild with a 3% rate of return. What amount do we need? And what we're going to do here in 17 is we're going to take the $12,000 per year, divide by the 3% return, and we're going to get $400,000. Yeah, I don't know if you're going to see that or not. An investor is looking to invest $200,000. He first researches individual companies. He then researches each individual industry in which the companies are in and notices that some industries are doing better than others. He makes his selection to invest in the individual companies within the best performing industries. Well, he's starting with the stock and working his way up, and so that's called bottom-up approach. Now, I think you're more likely to see top-down approach, where we start with the economy, then we look at the industry, and then we pick the stock. So I think it's more likely on your exam you're going to see A instead of B. I don't know why people turn this into something other than what it is, which is an aim and shoot point and click question. It's just an aim and shoot point and click question. It's December 31st. Again, if you're going to buy the PDF, I would highly recommend making that a poor man's flashcard, and night of or morning of, just go through and read, all the questions and the right answers. Night before, morning of, or perhaps both, particularly on questions like that are aim and shoot. That's a layup. You don't give any layups on 66. So any layup you get, you got to really make sure you perform. I don't particularly care for Brian's phraseology here, but I do like his intellectual takeaway from this question. I can't cherry pick my recommendations. I can't take a mulligan for investments. I have to give you, the way we say it as a test question, is I have to give you the entire universe of my selections, no cherry picking. So I don't particularly care for the phraseology here, but I do like ultimately the takeaway. Now, I told you I'm doing my spin, my explication on Brian's question. So when you get the answer key and rationale, his reasoning on some questions will, I think, be the same as mine, but on others they may be different. But that's the advantage of having two voices. An investment advisor works for a federally covered investment advisor. The investment advisor's main office is in state A. The investment advisor travels to see a client in state B. On the Uniform Securities Act, which of the following is true? Which of the following is true? The investment advisor need not be registered in state B. That's true. You know, you as a 66 need to be registered in state B only if you have a place of business there. You have no place of business there, and so you do not need to be registered in state B. The investment advisor need not be registered in state A since the AA is federally covered. No, you know, you're going to have to register in the state in which the home office is, right? So that's going to have to do that. 3, the investment advisor needs to be registered in state B. Well, those are mutually exclusive, that we just did that, right? And the investment advisor needs to be state A. There we go. Now, again, the answer to 21 here is B. But if you're going to do poor man's flashcards, you don't want to be looking at answer sets. What I mean by that is in a poor man's flashcard, what you want to do here is you want to get rid of the wrong answers and just read the questions and the right answers. So, boom. I like that question. That one's pretty spot on. Multiples, you're going to get 2, 3, 4 multiples, not nearly as many multiples as test prep providers have for you. And a state has its principal office in state B, 22. And in 3 other states, the investment advisor must meet the capital requirements of state B. Yeah, you only have to meet the requirements of the state in which your home office is in. So that sounds pretty good. But as I said before, let's just read the rest of these answers to see if Brian perhaps has something better for us. Meet capital requirements in state A. No. Meet SEC requirements. So be careful. One of the challenges on your 66 is what I call brain meld, where you get all the stuffed in your brain housing group. No, the SEC requirements are for a broker dealer. So, you know, here it says capital requirements. If that was a broker dealer, the capital requirements would be what the SEC mandates, and the state couldn't have something higher. So be careful on this exam, whether you're being asked about broker dealers or not. We're being asked about an investment advisory firm. So, you know, make sure you read. I mean, I would highly recommend you read the question once for context to make sure you're clear in what you're being asked, If a federally covered investment advisor, sorry about that. Let me move that back. If a federally registered investment advisor has its principal office in state A and has offices in 3 other states, and a client of the investment advisor who is registered in state A moves to a state in which the investment advisor is not registered, then the investment advisor representative. So I think, by the way, I think one thing I'd recommend for the grammar is every time it says investment advisor, I'd make it your firm, whatever your firm was. My investment advisory firm was Gamma Global Investment Advisors. And then every time it said investment advisor rep, I would say, oh, that's me. That's me. So who's registered in state A? So, and a client who moves to a state in which you're not registered. Good news, I'm federally covered. So boom. I just was checking one more time to say, make sure who was moving. So be careful. It wasn't the rep, right? It's the client, a client who moved to the different state. Remember, I only have to be registered as an investment advisor representative in the state if my client moves, if I have an office there. The FDA has changed their rule regarding testing of a new drug from 1 to 2 years. I like this one. I think Brian has got a pretty spot on question here. That's regulatory risk. Legislative risk is testable. Legislative risk is the idea that Congress giveth, Congress can taketh away. So anything that has tax advantage, like a Roth IRA, Senator Roth is not here. Recently, they changed the tax status in a favorable way for alimony. So legislative reward, I guess. They changed the dividend exclusion from 70% to 50%. So I would definitely know legislative risk is any tax advantaged investment where Congress could change that rule. Regulatory risk is this one. Inflation risk, also closely allied with purchasing power risk. I would definitely know about tips as a potential thing that could keep pace with inflation, and common stocks that could outpace inflation. And the market risk, there is a tendency of securities prices to move together. That's also known as systematic risk. systemic risk, and risk despite prevails despite diversification. Well, I told you this is very much the answer set that I keep telling you for options is important. And I'm hoping that it hasn't been so long ago from your Series 7. A covered call is used to generate additional income. So the answer 25 is C. When does an SEC registered corporation not have to file an 8K? An 8K is a material current event. A material current event. So, Microsoft is buying Activision. That is definitely something an 8K shareholders need to know about. A change in the top management, absolutely. A change in the external CPA auditing firm. Relocation of a wholly owned subsidiary. No, that's not material. Kaplan is a subsidiary of Graham Holdings. Graham Holdings is in Virginia, and Kaplan is in La Crosse, Wisconsin. If they move that Kaplan to Florida, that's not a problem. I probably would have used Sesame Street trick to get this right. One of these things is not like the other. One of these things is not like the other. Now, by the way, be careful. That's at headquarters, then that would definitely. Tesla's moving from Fremont, California to Texas, Austin, Texas. That requires an 8K. So it's a subsidiary here. Mary and Joe, age 55 and retired, have a small inheritance that pays their living expenses. However, they do not have enough for retirement. Which of the following should an agent recommend? So let's think about this. I'm going to need some income, and I'm going to need some price appreciation. I'm going to need an opportunity here for total return. Total return is both the income stream from the investment, and the price appreciation. And so investment in bonds, I don't think that's going to be a good answer, because bonds aren't going to give us price. Well, they could, but don't overthink it. It looks like to me, I like bonds and equity. I think that's the one I would choose. Equity, a little too risky. Money market is for short-term parking spot for money, not really so much as an investment. Is something you're parking money to do. So I'm going to go for B there. I'm going to go for B. A federally covered advisor has a home office in state A. It solicits 5 customers in state B, and it holds a seminar in state C. Which of the following is true? Now, again, what I recommend is that, you give some state's name here. So federally covered advisor has his home office in Nevada. It solicits 5 customers in California, and it has a seminar in Utah. Which of the following is true? I don't need to register in any of these states. Again, because I'm federally covered. So the answer there is D. The answer is D. An advisor is considering purchasing a thinly traded stock for his client's account and his own account as well. He should purchase the stock for his clients first. That sounds pretty good. Purchase the stock for himself first. Ooh, I'm not supposed to trade ahead of customers. Purchase the stock all at once for everybody and average out the price paid. Purchase the stock all at once for his own account and then resell it. Ooh, that's going to be bad because, you have conflicts of interest in D. I think the most ethical thing to do here would be to purchase the stock from my customers first. Customers always come first. On an ethical standard, right? I get upset when other people don't follow our rules. I went into a Starbucks and the barista said she's making her own latte. He'd be right with me. And I felt like telling her, listen, my latte should come first. My latte should come first. That's what's my egg timer saying that we've hit our first 30-minute mark. So if you are going to want to take a break, or you can take any break you want. Most people aren't wired for 30, 40 minutes, hour and a half of sustained concentration. That's what's great about the video. You can hit the stop button, go get whatever you need, come back, take a little break mentally and come back to it. So that's 30 minutes. If you want to take a little break, I'm going to go ahead and continue to march here. And so let me put back up the screen. Remember, on the channel, we have lectures that are vary in length from anything that suits you. We have some that are 10, 15 minutes long. We have others that are hour and a half, 2 hours. I got, over 2 hours. So whatever, strikes your fancy. I don't really worry about longer lectures because I think you can hit the pause button whenever you'd like. So the CEO of XYZ, welcome back if you took a break. The CEO of XYZ is the trustee for his company's employee pension plan. He gives instructions to the investment advisor representative who manages the plan to loan the company several $1,000s to pay off the company's bad debt. You, as an investment advisor representative, should do what? What should you do? You should not, ERISA says you're a fiduciary, so you're not supposed to be helping people do bad things. And so the answer to 30 is C. ERISA prohibits transactions with parties that have adverse interests with that of the pension plan. Boy, if you said seriously outperforms the market on 31, you got a problem. You should have been able by process elimination just to know that, right? An S&P index fund has a beta of 1. It has a beta of 1. It has a high dividend payout ratio. We don't know that. I mean, that's more about a common stock or, perhaps a stock portfolio. It has low management fee. Yeah. I can't imagine any draw in which you're not going to get a question about suitability of an index fund as being the appropriate recommendation for someone. And the other one where this would be the right answer, if somebody says they believe in the strong version of the efficient market hypothesis, also known as random walk, and that it's a waste of resources to try and outperform the market. They're willing to accept a market-based return. And then you would say, maybe an index fund would be the right thing there. So you're going to get the index fund once or twice as a suitability question. Are these also more tax efficient than actively managed funds? So low management fee, more tax efficient. And then I would know the beta would be 1, right? The index fund has a beta of 1. So you're not getting any alpha, you're giving up on the alpha. An advantage of investing in a mutual fund of foreign stocks, the reduction of the risk of currency fluctuation. No, I mean, I still have currency risk. That's not an advantage. The investor does not have to choose the foreign stocks. That sounds pretty good. A friend of mine goes, "Hey, Dean, we got to buy Peruvian stocks in Peru." I said, "I know nothing about Peru." He said, "Well, I'm going to call the embassy and find a reputable broker in Peru and buy some Peruvian stocks." I said, "Well, listen, if I was going to do that, I would do it through a Latin American mutual fund where I got a guy who speaks Espanol, knows about South America, knows the locals, and is diversified not only in Peru." Anyways, he told me that he was making money and I should have done it. And then, I said, "Well, did you make money in the Peruvian currency or the US currency?" So we did the math. He actually hadn't made money because he lost money based on the exchange rate. Elimination of market risk. You should never take answers that say you can get rid of market risk, because remember, you can't get rid of market risk through diversification. Risk prevails despite that. Reduction of a foreign tax liability. No, you're still going to have to pay the local country of origin its taxes. By international treaty, just for your own edification, is typically 15% as the withholding on investments you make overseas. I don't think you'll see that at all, just your own edification. Surrendering a whole life policy is appropriate for all the following except. So there, I don't particularly like this one, but I think what Brian is getting at is we shouldn't be doing this, to just get cash. So appropriately except. So 33 to get cash, all the following except. So, purchasing a paid up term loss, purchasing reduced, purchasing a non-qualified annuity. I don't particularly like this question. I don't particularly like the question, but boom. I think what he's getting at is a 1035 exchange is what Brian's getting at in that question. If a client takes out a loan from his whole life policy and does not pay it back, the insurance can do which of the following. This is very much something to be aware of on the test. Definitely something to be aware on the test. Yeah, I think this is very much a good poor man's flashcard. So again, definitely that is high probability. Which investment is more tax efficient? Well, here we go. Brian just basically nailed the question I told you about to be aware of here. Boom. Right. The index fund, because the index fund is not actively managed. Brothers Jim and Joe inherited $10,000 and invested in mutual funds. Jim redeemed the shares several times over the next several years and placed money in a savings account, leaving a balance of 11 grand. Joe did not redeem any of the shares and has a balance of 50 grand. Jim experienced which of the following risks? So they both got 10 grand. Jim has redeemed several times over the next year, placed money, leaving a balance of 11. Joe did not. Oh man, Joe seems like he did better. Jim, I like the cast of characters here, right? Jim experienced which of the following? Well, there's nothing in this thing about interest rates. The answer to have this question be about interest rates, I would have to have something in there about interest rates. There's nothing in here about inflation. There's nothing in here about liquidity. So by process of elimination or just knowing the answer, it's the opportunity cost, D. An investment advisor representative notices while compiling a financial report for a client that there may be a significant consequence in the future. Now, again, I don't really care for Brian's phraseology here, but I do love the takeaway. We as investment advisor reps should never tell people that we are accountants or attorneys. If they need, tax advice or legal advice, we should send them to the appropriate qualified individual. So, I'd be prepared for that as a test issue. I'm not sure you'll see this phraseology that Brian has used here, but that's definitely testable. I say, listen, I'm not your, tax guy. I'm not your legal guy. I'm your investment guy or gal, whatever the case may be. So again, don't care for Brian's phraseology here, but the takeaway is definitely testable. I always found it surprising how many wealthy clients I would have who get frugal in a bad way, cheap, when it comes time to pay attorneys and accountants, and those are monies well spent. Which of the following would be best way to file a tax return for a single father with 2 children? So I think the best way to go here is going to be head of household, right? C. 68-year-old woman is seeking preservation of capital with a secondary objective of income. Which of the following would be most appropriate? Savings account, money market, CD, muni bond. Well, I think I would go process of elimination again. There's nothing here that says she's rich or anything about being in a high tax bracket. And so here at 39, savings account, income. I think we'll get more into. We're not going to get much in income. I don't like Brian's answer set here, but by process of elimination, I think the best thing to do is put her in a money market fund. So I'm going to say that the answer here, even though I don't like any of these answers, is B. According to modern portfolio theory, investing in multiple asset classes attempts to reduce which of the following very much market risk known as which of the following market risk? According to multiple asset classes. Again, what we're trying to get at here again is this idea of negative correlation. So what I'm trying to do is get the maximum risk and reward out of a portfolio. And so while we can't reduce it entirely, we can take action to mitigate that through, again, this idea of negative correlation. By the way, again, I don't really particularly care for this question, but it's not liquidity risk. Modern portfolio theory isn't about liquidity risk. It's not about credit risk. It's not about interest rate risk. It's about market risk. So I should have got it that way. You're definitely going to get tested, Uniform Securities Act, about what is or is not a transaction or sale. An offer accepted becomes a sale, a transaction, and what is or is not part of the jurisdiction under the Uniform Securities Act. And so in 41, giving a security as a bonus is, entering a contract to sell is, that's 1 and 3. Pledging securities as collateral for a loan is not. I would definitely know. By the way, the test takeaway here is Roman numeral 2. When you pledge securities as collateral for a loan, bona fide is Latin for good faith. And if I'm your lender and you pledge securities to me as collateral and you don't pay me, I can sell you the securities and not be worried about running afoul of the Uniform Securities Act. And so the answer to 41 is C. A husband and wife are 55 and 57 respectively. The husband plans to retire at 62 and the wife at 65. Both are healthy. What is the appropriate time horizon? Boy, Brian, be careful here. It's not about their time horizon. You know, Brian, I mean, man, Brian is as big a jerk as the state administrators, I'm joking, as NASA. But this is really important. Sometimes you might want to read the last question, the last sentence first, just to see what this is about. So I could very easily miss this thinking I'm being asked about their time horizon to retirement. That's not the question. The question is the time horizon for their portfolio we're going to create for them. And we would expect them to be living, breathing human beings walking planet Earth for 20 plus years, right? According to the actuarial tables. So the answer 42 is D. An investment advisor hires a solicitor to recruit clients. According to the Investment Advisor Act of 1940, what records would the investment advisor be required to keep? Remember, I have to give you as a third-party solicitor. You know, that's what I did for a big part of my career. I have to give you a brochure that explains to you who I am, the third party, in this case, Comma Global Investments. That was my broker dealer. And who the investment advisor is, in this case, Carlyle. And give you a brochure, their Form ADV Part 2 or their brochure. And then I get you to acknowledge that I've explained this to you so you understand that these are two separate parties. All right, so I just need you to do that. A receipt of any fee charge, and that's going to be the investment advisor. Written agreement between the client and the solicitor? No, you're not hiring me, the third-party solicitor. You're hiring the investment advisory firm. No records are required. Now, remember, I also have to tell you if you're going to incur any additional fees from using or accessing this investment advisor through my broker-dealer, the third-party solicitor, and then only federally covered advisors are allowed to use third-party solicitors. If you're soliciting clients, recruiting clients, and for a state investment advisor, you have to have a 65 or 66 and work for them. 44, what information do you need to determine the future cash flow from a bond? The future cash flow. The principal amount, the rate, and the number of payments. That sounds pretty good. The principal and rate, remember, discounted cash flow means I'm going to have to know how many payments I'm receiving and when. So A sounds better than B. The amount of the interest payments and the current bond value. Well, no, I also need to know what the ending value is. Current bond value, rate, and maturity date. The answer there is A. A. Which of the following is considered a person? I like this. It's not going to be like Brian, but remember the key point, it doesn't matter that he's a prodigy worth millions. The point here is they're a minor. Minors are not considered persons under the Uniform Securities Act. That would also be true of people who've been declared legally incompetent. That also be true of persons now deceased. It is very, very testable. 46, an agent of a broker-dealer key. This is a broker-dealer. So key, broker-dealer, whose home office is in state A has a client in state B who has their mail forwarded to state C. Well, you know, as an agent of the broker-dealer, how do I know you're forwarding your mail? I mean, I have no clue you're doing that. So I have to be registered in the state A, and I have to be registered in state B. So the answer is C. I have no idea where your mail is being sent. And so, you know, how the heck am I supposed to know that? 47, an investor has purchased an index-based annuity with minimum rate of 2%. So under no circumstances am I going to get less than 2%. By the way, since I can't lose money, this index-based annuity is considered to be not a security. Not a security because I don't have capital risk. I can't lose money. The annuity has an 80% participation rate. If the index rises 20%, what would the customer receive? So what I'm going to do is, this is very testable, by the way. I'm going to take the 20%. I'm going to times it by 80. And I get 16 is my 80% participation rate. There's a 2% minimum, so it looks like it's going to be D. I'd make a note to yourself, there's no negative reset. So be careful on the test on debrief. Lots of people tell me they get a question about where the stock, this index goes down like 15%. And then remember, the client is going to get 2% in this case, but it never goes backwards. So whatever the reset we do annually is, that's where it's going to stay. I would definitely expect a question on equity index annuity. 48, an investment advisor is a trustee of a trust with 2 or more beneficiaries. According to the prudent investor rule, which of the following is true? Which of the following is true? Trustees should take into consideration the beneficiaries and act impartially. The trustee should not take into consideration the beneficiaries and act according to the investment policy as stated in the trust agreement. I don't really particularly care for Brian's question, but what he's getting at is you have to follow whatever the trust terms are, right? Recently, what is it called? It's on, I think it's Netflix, the McKinsey Method or something, and it's Michael Douglas. Michael Douglas is an actor, and his agent dies, and he puts him in charge of the trust. You can tell, I think it's Chuck Lorre who's the producer, but when he dies, he makes this actor, Michael Douglas, the trustee. And then the beneficiaries, his son and daughter, keep asking him for money from the trust to do whatever they want, and because they're the beneficiaries. And I think whoever writing the script is spot on about trust. The answer there is B. 49, which of the following efficient market hypothesis dictates the future performance cannot be based on historical data? So we said you're going to get one of those, and that would be strong, because remember, in both technical and fundamental analysis, we're actually looking backwards at either charts, pricing patterns, or looking at the last 10Q or last 10K. And so that would be strong. What do an S Corp and a general partnership have in common? What do they have in common? Both of them are flow through investment vehicles. And so that means the S Corp and the general partnership aren't paying, the partnership are not paying taxes, the owners are. They do not have an ease of transfer of ownership. In a partnership, you can't get in or out without the permission of the partner. They both provided a limited liability. That's not true. The general partner has unlimited liability. Ease of formation and continuation. What does that mean? Partnerships have a finite life. So given that answer set, it's C. On debrief, people tell me they've seen a question about a husband and wife who have a general partnership. That's how they own their business. And why would they go from a general partnership, dissolve the general partnership, and go to an LLC? And the one that I would think would be the answer in a scenario like that is, as general partners, they have unlimited liability, and LLC they don't. So you're going to get at least a question or two on forms of business ownership. The application for a registration for an investment company act of 1940. So you want to start your own mutual fund. I don't know why you would, but if you do, you would make that registration statement with the SEC. There are more mutual funds than there are Taco Bells. There are actually more mutual funds than there are securities put into them. The internal rate of return calculation dictates that the interest earned in a portfolio is reinvested. I like this. This is a good one. Brian's spot on. They want to bait you on the test to say that it's a T-bill or it's a T-note. No, it is whatever we assume. I like that. That's a good poor man's flashcard. I know a lot of my people I know use a Treasury note, but you could use whatever you want to do that calculation. In fact, I might use a different rate to do it 2 or 3 times, see what the numbers look like. Which of these factors is not relevant in determining if someone is an investment advisor? So the definition of an investment advisor, A, B, C. I give investment advice. I tell people I'm in the business of giving investment advice and I want compensation. And it doesn't matter the frequency of that advice, right? Oh, by the way, whoop, my bad. You got to pay attention to these knots. I think I almost missed that based on not catching that knot. Yeah, B, C, and D. You give investment advice. You tell people you're in a business of giving investment advice and you want compensation. I like this one. A diverse portfolio would own tangible assets. Tangible assets would be like precious metals, gold, stamps, real estate, that kind of thing. And those would be something would be a good inflation hedge. I like that one. That's another good one. $55. Both an investment advisor and investment advisor representative register in August. They do not have to renew their registration until March 30th. Oh, they do not renew their registration. Which of the following is true? I like this one again. This should be an aim and shoot, point and click question. So I don't know why people turn this into something other than what it is, which is a name and shoot point and click question. So again, I think that's another great poor man's flashcard. $56. An investment advisor realizes Monday they've fallen below net capital requirement. Remember, that net capital requirement on the state level is either going to be 10 or 35 grand, depending on whether you have custody. They contract the administrator on Tuesday. When do they have to provide the administrator with full financial documents? When do they have to provide the administrator with full documents? Well, you have one business day to do that. You have one business day to do that. So that's going to be B, Wednesday. An individual employed by a federally covered advisor would be required to become registered as an investment advisor representative in the state if the only clients receiving the individual advice are large pension plans. So by the way, when you got a big answer set like this, I like to slow down and go back and start again slowly. An individual employed by a federal covered advisor, I'm going to say me, would be required to become registered as an investment advisor rep in the state if the only clients receiving the individual advice are large pension plans organized for employees of municipalities located in the state where that individual, there we go, maintains an office. So the rest of that is just Brian trying to throw us off the track. All that comes before that is meaningless to answering this question, which is A. I like A. Let's look at B. The only clients receiving are banks located in the states. I don't have an office. C. The only clients are companies. I don't have an office. D. I prepared a research report. That has nothing to do with it. A is our answer. Again, hopefully now you're getting confirmation of this idea of when do 66's investment advisor reps need to be registered with the state. If you're federally covered, it's the home state, and then only if you have a place of business. Under the Uniform Securities Act, when an investment advisor rep is acting in the capacity of a trustee for a family trust, executes a transaction on behalf of that trust, the answer is C, that is a non-exempt transaction, because that's not a definition of that, right? So, this is not a fiduciary kind of related transaction. So Brian's trying to bait you on that one. 59, Sharon Smith is an agent for a broker-dealer registered in all 50 states. Key point, broker-dealer again. Boy, be careful when you're doing questions, broker-dealer. Sharon receives an unsolicited order from a bank located in state X, in which she has no place of business. Well, her having no place of business isn't about broker-dealers. That's about investment advisory firms. Under the Uniform Securities Act, Sharon must be registered in the state, right? If you are a broker, there's no de minimis for brokers. If I have a client in the state and I'm taking orders in the state, I have to be registered in the state. So the answer is B. I remember the no place of business is for investment advisors. It's not, associated persons of a broker dealer. It's not D. There's all kinds of people. Schwab is in all 50 states, but not all of its reps. So the answer is B. Key point, make sure when you're doing questions, you're paying attention about whether you're being asked about broker dealers or investment advisors. A FINRA member broker dealer is registered in 10 states. Regarding the financial statements, again, this is not an investment advisor, 10 grand, 35 grand. No. This is a broker dealer, and the capital standards, the financial requirements of a broker dealer are set by the SEC. And therefore the state cannot impose upon a broker dealer a higher standard than that of the SEC. So again, this is a spot on question Brian has here. I think that's a good poor man's flashcard. Again, be real careful. Now it's an investment advisory firm registered in 10 states. And so again, now we're talking about the 10 grand or the 35 grand. The investment advisor must meet those. Remember, this is the second time Brian has shown you this question. Right? I can't have a bunch of states telling me what hoops to jump through. And again, good poor man's flashcard. A federally covered advisor has offices in 10 Midwestern states. Regarding the record-keeping requirements, the investment advisory must meet those. Well, that's the whole point of being federally covered, right? The whole point of being federally covered. I have a lecture. I highly recommend it. I know you're not surprised. It's called Who's Your Daddy? And it's either your daddy is either going to be the state administrator or administrators or the SEC. I highly recommend you watch it. I have 2 narrative lectures, the Mighty 90 on the Uniform Securities Act, 90 minutes on the Uniform Securities Act, and then Who's Your Daddy? Make sure you read them both, or watch them both, excuse me. 63, with regard to the North American Securities Administrator Association Statement of Policy on dishonest and unethical business practices, broker dealers and agents' prescribed actions would include. Now, prescribe just means prohibit. And, I think Brian is doing this on purpose. You're taking a legal test, and you know how attorneys talk. So I had a young lady, she passed, but can you imagine this? Her primary language was Mandarin. And she would put in some of the words from the 66 into the translator, and nothing would come back. I said, well, that actually doesn't surprise me. Accepting an order from a third party after you've got written trading authorization to do so. That sounds copacetic. Affording a written complaint from a customer or an appropriate supervisory person sounds copacetic. That's the word for sounds good. Offering to hold the customer harmless. No. I'm not supposed to say, hey, if it doesn't work out, don't worry about it. I'll make it good. No. Borrowing money from a client. Doesn't matter if they're your college roommate. So 3 and 4. The borrowing money in investment advisor world is never a no-no. Chuck is the guy at Kaplan who writes the Kaplan Q Bank, and he has a question about not even your mother. So, 64. Savings and Loan Association organized in State A and authorized to do business in State B has an offering of common stock being made in State B. Ugh. So a savings and loan organized in Nevada, authorized to do business in California, has an offering of common stock being made in California. I suggest you to take care of the bad grammar on the 66 that you put in names, your firm, yourself, whoever it happens to be. In order for an individual, me, selling the offering to be excluded from the definition of an agent in State B, me, the individual, which of the following would be true? Yeah, if you work for the issuer and you're receiving no compensation, that looks like the best answer there. Broker-dealer, broker-dealer, you cannot sell with being an agent. Now, there are exemptions for somebody who represents the issuer and is not receiving compensation. So given that answer set, A is the best answer. An investment advisor representative of a federally covered investment advisor splits his time between an office in State A and an office in State B. So, what Brian's trying to get you here is with all these numbers here he's given you is to try and make you think this is something about de minimis when it's not. De minimis does not apply to federally covered investment advisors. So as a federally covered advisor, and I'm a investment advisor representative of that advisor, and I have an office in State A, a place of business, and I have an office in State D, a place of business in both State A and D, I'm going to have to register in State A and D. I like that. That's a good question. Following the advice of their portfolio managers, the hedge funds executes most of its securities through a registered full-service broker-dealer. In order to compensate for commissions charged, the BD allows employees of the hedge fund to use furniture and facility at a discounted rate. And remember, it's very testable to know what soft dollar compensation broker-dealers can provide to investment advisors that are running transactions through the broker-dealer. So it's not so much as a hedge fund. Hedge funds, the fund itself is typically not registered, but the manager of the hedge fund is registered as an investment advisor. And so this is really about what can broker-dealers do to help investment advisory firms help their clients. This is huge business at TD Ameritrade, at Schwab, at Fidelity. TD Ameritrade and Schwab merging, but these are investment advisors that use them. I used to use Schwab for execution and custody, and I would tell my investment advisory clients, I can't steal what I don't touch. Your stuff is at Schwab. So what they're asking is, what can Schwab do to help Dean? And so you should definitely know that furniture, travel is out, and rent. So as long as nope, this would be considered nope. It's not going to be considered allowable soft dollar compensation. I think that's my best answer. Let's just see what D says. This would not be considered allowable soft dollar compensation. No, there's no excuse there. I like that one again. Good poor man's flashcard. Right. An investment advisor representative is assuring clients of steady returns on an investment. Ugh, that sounds bad. Under the NASA model of unethical business practice of investment advisor and federally covered, this activity, I think I'm going to say prohibited here because it says assuring clients of steady returns. Yeah, it's prohibited because you're guaranteeing a profit. Oh, that's our second hour here. Let me turn over my egg timer. So, hey, so if you want to take a break, now is the time to do so. Remember, you can stop the play button on any of these videos anytime you'd like. I'm hoping you're finding these explications helpful. If you are, let me know, because if you are, there'll be at some point a practice test 3. If you're not, then there'll be no more practice test 3, right? So anyways, I'm going to continue to march. So if you'd like to take your break, that puts us at about an hour. I try and bring these explications in under about an hour and a half. Sometimes I'm successful. Sometimes I'm not. Anyways, 67 back. Welcome back. If you took the break, I'm going to say it's prohibited because the customer still experience a loss. I think the steady returns. I like A a little better than B, so I'm going to say A. Whoop. The state administrators consider that to be guaranteeing a profit. So whether Dean thinks that's guaranteeing a profit really doesn't matter. I think Brian's being kind of a jerk here to make you distinguish between, under or over on this one. But I definitely, he's saying which of the following would be considered a substantial prepayment. It's over 500. And so that's going to be 600 on the state level. So the answer there is C. I would be prepared for the more than 500. So I think he's just giving you an example of how that plays out, but it's more than 500. 600 is more than 500. Remember, on the federal level, that's going to be 1,200. There's a lot of stuff, and I highly recommend that you learn everything. But, the state versions of these rules are more important than the federal versions of the rules. And I do like Brian's, what do you call them, quick notes, where he actually breaks some of these things down for you and shows you both sides, the federal and the state, including the Uniform Securities Act definition of an exempt transaction. But yet, any transaction, I kind of like this again. Remember, fiduciaries don't have to worry about running afoul of this. So a sheriff is an officer of the court, a guardian appointed by the court trustee, all those are officers of the court. And so they don't need to worry about running afoul of the Uniform Securities Act. I think this is a great poor man's flashcard, but I would get rid of the except. And I would get rid of the wrong answer here on that. And I would definitely know A and B and C are officers of the court. They're fiduciaries. They don't have to worry about running afoul of the Uniform Securities Act. Any transaction made by a sheriff, a guardian, or trustee are going to be exempt transactions. That's a good one, by the way. A broker-dealer operating on the premises of the bank would have to make certain disclosures to the in an advertisement for all the following except. Now, again, I'm sure Brian wouldn't put this in there, unless somebody told him something. I mean, I've never had anybody tell me this is a testable issue. So remember the except here. By the way, test taking trick, it's a radio spot 30 seconds or less. They could burn up the entire 30 seconds, talking about disclosure. So the answer there is A. I might get rid of the except, I might get rid of the other, and then Marco. Again, next time I talk to Brian, I'll say, really? Has anybody really seen that? I've never heard of that on the test. Which of the following statements regarding email communications are correct? Over and over and over again, state administrators said they make no distinction. They make no distinction between a electronic communication and a snail mail dead tree version of communication. They make no distinction of that. So they're sometimes referred to as electronic communication. Sure, why not? Customer complaints by email are not considered to be in writing. No, that's absolutely not true. Once received and reviewed, they may be discarded. And yeah, 1 in 4. There's no distinction. I like Brian's question here. I like what he's getting at here. I'm not sure about that phraseology. If it'll be exactly like that, but something along those lines is definitely. something you'll have to encounter on the exam. Present value is a computation that's frequently used to determine the amount of a deposit needed now to meet a future need, such as college education. So as your investment professional, I thought we were going to get 8 and we got 10. Woohoo! And so that means the future value, it looks like we're going to have more money than we thought. That's a wonderful thing. Yeah, that'd be a good thing. Again, I like Brian's questions here. Again, very much like the test. Not so much can you do the math, but you have a general understanding of what the math would, end up doing. Client enters an order to sell stop at 45, limit of 45 and a half. So remember, sell stop, I'm looking for 2 things here. So I'm watching CNBC, and on the bottom of CNBC, there's a tape going by. And the first thing I'm looking for is a trade at or through 45. And then I'm telling my investment professional, sell it, but only if I can get 45, 50 or more. So now we go through the sequence of trades looking for a trade at or through 45. Ding, 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 ding. There's no way on a number line to go from 45.12 to 44.97 without trading through 45. So now we have a live limit order to sell at 45.50 or more. So I'm not going to accept 45.25. I will accept 45.97. So again, this is more 7 flavor. Hopefully you 7s. So it should look familiar. Over the past 5 years, an investor portfolio has shown returns of 6%, 4%, 11%, 10%, and 4%. Which of the following statements is true? Well, I can kind of go about this through process of elimination. The range, it says the range is 7%. So it looks like we go from 4 to 11. So that looks true. So I need a 4 in it. So now I got a 50-50, right? The range is the low number to the high number. So I need a 4. So that's pretty helpful because now I know it's either C or D. I don't need to burn up brain cells on Roman numeral 3 because if I'm taking 4, I've got to take 3. So all I got to do now is look at 1 or 2. The mean return, so in 75, if we add all that up, we're going to get 35 divided by 5. And that means the mean return is going to be 7%. Ding, 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 ding. I have the answer. Brian actually has 2 of these in in this exam. I think maybe 1 is what you would see on the actual exam. A fiduciary of an ERISA plan, ERISA stands for every ridiculous idea since Adam. No, I'm joking. It stands for the Employee Retirement Income Security Act. Is preparing an investment policy statement. Included would probably be, so specific securities, I probably would approach this with process of elimination. We're not going to tell you what specific securities will be selected within the plan. I mean, I call that test-taking trick reduction to the ridiculous. What would the world look like if that were true, right? I mean, no. Methods of performance measurement. That sounds pretty good. Determination of meeting future cash flow needs. Absolutely, right? How much money are we going to be able to need to pay our retirees? Well, let's see. So 4, the summary plan document. That's a different document. So those are, so the answer here is going to be B, 2 and 3. I think that might be a good poor man's flashcard. Oh my goodness. An investment advisor rep prepares a detailed portfolio restructuring for a new client. The client is not impressed with the recommendation. And at least to the investment advisor rep, it appears that the rejection is more due to a lack of understanding and valid dislike. What should you do? You make the call. Prepare a new set of recommendations that will hopefully be received more favorably by the client. I don't know. Let's read all our answers. Go ahead with the recommendation anyway, because the client's lack of absolutely not, so we can get rid of that one. Whoop, let me get out my. Suggest the client will not follow you. It would be best to find another firm to deal with. Yeah. Attempt to educate the client as to what his portfolio is trying to accomplish for the client, while at the same time recognize, given that answer set, D certainly sounds like the best answer. Too long to be wrong. Too long to be wrong. In the course of bankruptcy, the asset that backed a secured debt is liquidated, but it doesn't pay off all the debt holders for a particular secured debt. What happens to those debt holders? Now, you should definitely have an understanding of a junior to senior or senior to junior. I'm not sure that you get tested to this level, but they get grouped in with the general creditors. 78, a beneficiary passes away and the heirs receive the assets on the trust. They're known as, don't you love that? Again, too long to be wrong, the Remainderman. You should definitely know it's not the corpus, because the corpus is actually the body of the trust. The trustor or grantor are not, the people who are receiving money. They're the ones either bequesting it or managing it. An agent of the BD sells unregistered common stock to an insurance company that has no office of the state. According to the Uniform Securities Act, the insurance company is capable of protecting their own assets, their own interest. And so the answer is B, right? If I'm dealing with institutional investors are capable of protecting their own assets. Which of the following payouts from a non-qualified annuity, so that means after-tax money, would assure the annuitant the largest monthly payment? That is very much a test question. And the answer is D. That is very much a test question. And I would definitely make that a poor man's flashcard. I'm sorry, I can't draw a very straight line there, but very much a poor man's flashcard. Your life and your life only. An investment advisor delivers an investment advisory brochure to a client at the time of the contract. According to the Uniform Securities Act, this would be, well, no, giving you the disclosure is a good thing, right? So you should get rid of A and C right away. The way I think of it is D, you have a free look period. If you don't do the 48 hours, right? The 48 hours means you don't have to do that. The CEO offers securities in public in its place and receives, keyword, remunerations. That means payment. That's what that means in English, payment. And remember, that's exemption is for people who aren't receiving compensation, payment. 82, they're receiving payment. And so that sounds like this guy is going to have to register as an agent of the issuer because he's receiving payment. An agent over here is XYZ will report negative earnings this quarter. According to NASA, use the information. And the best thing here, the way to proceed is to do nothing, right? You shouldn't use material non-public information. And God knows you don't give it to the trading desk. Absolutely not. A state registered investment advisor is acquired by a federally covered investment advisor. And all the client's accounts are then transferred to the federally covered investment advisor. According to the U.S. Uniform Securities Act, this would be, I don't particularly like the phraseology Brian has, but boy, what he's getting at in this question is certainly attestable that investment advisory contracts need written consent to be assigned, and that's definitely testable. What I mean by his phraseology, Brian here is trying to stretch your mind a little bit and hope it doesn't go back to the same spot. I think what he's hoping here is you'll get hung up on federally covered and state. It doesn't matter. If you are an investment advisory client who hired firm A and now firm B has acquired firm A, you're entitled, that's considered assignment and it requires your permission. And that is very much a test issue, One of your clients dies, who can you take instructions from? One of your clients dies, well, it's going to be the administrator of whoever the court says is the person who can make decisions. I'm not sure one of your clients dies, who can you take instructions from? The spouse, the general account, I'm not quite sure. The durable account power of attorney goes bye-bye. So I could get rid of this pretty easily. I can get rid of this. If I miss this, I would probably overthink it and say it's a joint account, but there's nothing that says this is a joint account of anything. So given that it doesn't tell me it's joint tenants with rights of survivorship, I'm going to go for D, and I'm assuming that they died intestate with no will. According to the Uniform Securities Act, which of the following clients may an agent borrow from? Well, a bank and a bona fide loan would be okay. And a broker dealer and a margin account would be okay. Both the bank and the broker dealer give loans as a normal course of their business. And as long as you're getting a loan through the normal course of getting a loan like anybody else does, the way we say it on the test is a bona fide loan from a financial institution, that's fine. What's not going to be fine is getting a loan from your best friend. Oh, by the way, may an agent borrow from? So I just got my answer. I started to walk myself out of my answer. And I like 1 and 3. Let me see if Brian gives that to us. He does indeed give that to us as an answer set. An important measurement of a company's liquidity is to determine the company's current assets less their inventory divided by their current liabilities. Now, you are going to get an answer set that looks something like this. And the current assets less the inventory is called quick assets. So the current assets less inventory is quick assets, and then divide is the quick ratio. Working capital would be current assets minus current liabilities. I would know that. That would be working capital. And current ratio would be the current assets divided by the current liabilities. I would know all of that. This is never going to be an answer, right? But those other 3 are testable. An agent sharing in commissions with another agent may do so only if, I like this, we don't give concessions, discounts, allowances to people who are not properly registered. And so both of those agents are going to have to be properly registered. You don't need consent or disclosure to the customer, but you need to be registered, properly registered. So 2 and 3, which is choice C. And, you should get rid of this, but one test taking trick is reductions to ridiculous. What does it look like if every person who wanted to have a team in the office has to go to the SEC and get consent? One respect in which LLCs differ from S corps is that an LLC can be formed with as little as a single investor. There's no statutory limit number of investors in an LLC. That is a key distinction. Remember, with the S corp, there is a statutory limit of 100 investors, of which none that can be aliens. And so here, I told you, you're going to get questions like that. And then make sure you understand the C corp doesn't have the flow through. It has retained earnings, whereas the others have the flow through. This recently has changed. This is recently changed. And when they change, it takes NASA forever, but this is a recent change. So let me just tell you, if I were you, I'd get rid of that question. And that's typically what they do, is they remove it from the answer set or the actual NASA exam, and then they tell you when they're going to start testing on it again, or they make a distinction on the NASA when they're going to start testing on it. So check either the NASA website or your paid provider. Remember, this is a free supplement to your paid study vendor prep provider. And Brian is a paid supplement, free paid supplements. We're supplements. We're not a substitute for your paid study materials. So make sure if it's Kaplan, you check in for any updates. Which of the following retirement plans would have the least tax consequence? I kind of like what Brian's getting at here. I think what he's getting at is that one of these has a cost base, and so I'm going to have less consequence getting it out, right? A non-qualified retirement annuity is, it's also known as a variable annuity, is done with after-tax money. Which of the following would be most appropriate? Well, you should definitely have been able to do process of elimination. You should definitely know that's out, because life insurance aren't securities. Art collection, that's out. Muni bond is out. So too long to be wrong. Gold coins minted by the U.S. Treasury. I don't think it's really so much the gold coins as it is knowing that you don't put life insurance or art collections and tangible assets into a retirement plan, an IRA, and you don't put muni bonds in there because they're already tax-free, right? That would be something you do with your after-tax money in a high tax bracket. An investment advisor receives a check from a client made to a third party. So I told you my example, my investment advisory firm was Gamma Global Investment Advisors. And I was using Schwab for execution and custody. As much as you try and explain that to people, they just don't get it, right? So instead of sending the check for $500,000 to Schwab, they send the $500,000 to Gamma Global Investment Advisors. So Gamma Global Investment Advisors, the investment advisor, has received a check from the client made payable to a third party, in this case, Charles Schwab. According to the Uniform Securities Act, to avoid custody, the investment advisory firm, Gamma Global Investment Advisors, must forward the check to the third party. This is very much a test question within 72 hours. That's another great aim and shoot point and click question. You wish you got a lot of these. These are recognition. And again, I think this is a great poor man's flashcard if you have the PDF and can print this out and turn these things into poor man's flashcards. Your client has won the lottery and is considering whether to take a lump sum payment or receive periodic payment. I kind of like it. Again, Brian's math questions are pretty spot on. You know, and what I mean by that is the vast majority of the test is not, can you do math? Can you recognize the math that needs to be done? And so you should know it's not about a holding period return, because that's about, how long I held the investment, 3 months multiplied by 4 to get a holding period of a year. It's not opportunity costs. Opportunity cost was giving up investment A to make investment B. It's not risk adjusted return. So a lot of these can be done by process of elimination. An investment policy statement, which is not required by law, provided by the plan administrator, must include all the following except, again, it's not going to identify individual securities. And again, maybe I turn this into a poor man's flashcard. I get rid of the except, I get rid of the B, and now I have the truthful information I'm supposed to know. A testamentary trust may only be created by which of the following? And again, another good aim and shoot point and click question. Brian's got an exam here with, I think, some good aim and shoot point and click kind of testable content. So statement of cash flow. So cash flow is going to be money flowing through, because we're trying to find perhaps some money to do dollar cost averaging, do some things. Assets show up on the customer's balance sheet, not on the income statement. So assets are going to be on the customer's balance sheet. 3 years ago, a customer bought 200 shares of 50/50 upon death. So there's two situations on the test, very testable. One situation is the customer gifts these securities. That's not this question. The customer is not a living, breathing human being anymore, walking planet Earth. They're dead. And so the answer is there's going to be a step up in basis. So whatever the stock was trading at, that's what is going to be the step up. Now read carefully, If on the test they said 3 years ago, a customer bought 200 shares of ABC at 50/50, she gifts the shares to her nephew, then the answer would be 50/50. Both of those are there. So be careful. You're going to get this on the test. Either somebody has died and there's a step up in the basis. It's the decedent's, it's the decedent, that's the dead person. It's market value at their death. And the gift, it would be, you assume the cost base of where it gifted the securities to you. A portfolio manager has a value and management style which seeks stocks that have. So value means I'm trying to find undervalued things. So I know I need that, and I know I need that. And so given that answer set, D would be more of a momentum guy. I'm buying growth stocks, right? So momentum, so 3 and 4. Boy, I like this one. Assets minus liabilities equals net worth. So remember, it's not income. Boom. Okay, well, that concludes our explication of the practice exam. By way of reminder, the collaboration with TestGeek is that we get to explicate as our viewers and subscribers. We get access to the explications of the TestGeek final exams, like the one we just did. You also get a discount of 20% as a viewer or subscriber to my channel to TestGeek Exam Prep LLC's products. By way of reminder, there are 3 potential products for you. There's, if you want the PDF of the exam we just did and an answer key and rationale, that's going to be $24.95, call it $25. With a 20% discount, that's $20. And then you get the PDF and get the answer key and rationale. The next step up is for this quick notes here, which I think is pretty decent. This thing is, I think, a much better version, as you see here, of what Kaplan calls its quick sheets and what STC calls crunch time facts. And the jump up for that, I think, is $49.95. With our discount, it's $40. And then you get this great Cliff Notes version of the Series 66. I particularly like all of Brian's charts here. Like, here's a good one, right? I think that's the one I showed you. He's got lots of little good charts and stuff. So that's $40. And then by far the best deal is to just buy the entire supplement, which is $100, but with our $99.95 with our discount, $80. And I'll put a link in the both the video description to his website, and I'll also put a link to his channel, his YouTube channel, or a video there where you can sample Brian's videos as well. Like, share, subscribe. Let me know if you want to do some more of these things, because if so, we'll go for practice test 3 at some point. We took a poll on the community page, and that's why we're doing this one today. I'll put up another poll, and it'll probably be a while. Remember, tell people on the first leg, next one is going to be an SIE practice exam. There's already one there. We'll do another, and then it'll be 65, and then it'll be 6, and it'll be 63. I'll probably do 63 before 6. Okay, hope you enjoyed it, and I'll talk to everybody later. Bye-bye.